Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. In a recent Cathie Wood interview with Yahoo Finance, she proposed a theory that legacy auto manufacturers are hiding their lack of demand with lack of supply due to chip shortages. And she proposes that the reason consumers are not buying ICE cars because they want electric and not because they simply can't make them due to component supply issues. Also, another reason she gave is that last year, due to COVID, everyone bought their new car then, and thus demand has dropped significantly this year as a result. No one is arguing that there's a chip shortage in the world, but whether legacy are using it as a smokescreen for what's really occurring is open to interpretation. This is all about supply and demand. Tesla have even announced that they had to raise their prices of their cars due to chip shortages. The Model Y has increased $4,000 from the start of 2021. Well, if this is true, which I think is only half a truth personally, and that Tesla are also raising their prices to adjust for their excess supply they have, either way, if it's true, that would in effect mean that Tesla can justify $4,000 extra expense on chips that they can use to outbid the legacy autos. A chip is worth significantly more to Tesla than Ford, given that Tesla make closer to 30% gross margin per car, when compared to legacy autos at more around 10%. In addition to that, it's pretty clear that Tesla is the future auto manufacturer, and chip makers would rather keep Tesla as a happy customer compared to a drying up legacy auto company. There are lots of economic reasons to sell to Tesla over the legacy autos, not to mention what Tesla also likely have done to secure their supply chain. Remember, Tesla can always see many moves ahead as they are the leader in the EV industry. Anyway, I thought this was interesting and wanted to know more, and when it comes to trading, well, there is more than one strategy of how to do it. For those of you who watch Wall Street, can you recall what Gordon Gekko said was the most powerful commodity he knows? Information. Leave analysing numbers to the quants and chartists. And yes, I'm literally one of those people whose favourite movie is Wall Street. But if you can get information, then that can be used to trade. This is why a lot of people like to trade on insider information, which is somewhat illegal. If you can be creative though, and work out information yourself that can be used and think of a way to collect it, then that can be invaluable. In order to find out more what is really going on, I decided to ring about 10 car dealers in the US to conduct some first-hand market research of my own. Believe it or not, one of my majors at university was market research. I had to run focus groups, create questionnaires, and analyse the data. So it could be argued that I do have some credibility in market research. Now, I only picked a small sample here, but in market research, it doesn't actually take much of a large sample until you do get within a close enough standard deviation to draw inferences from the data. If all the car dealers are telling me the same thing, then we can try and analyse what is going on here. And I'm happy to share with you my findings. It would seem that all the Ford dealers are charging an extra $10,000 to $15,000 premium on the Marquis. One car dealer in Seattle even wanted $73,000 for a Marquis GT. Seriously, $73,000 is an insane amount of money for a car, especially one that carries a Ford badge. We know what we can get for the equivalent in a Tesla, except for $20,000 cheaper. Now, every dealer blamed it on chip shortages. Some of them actually went into some impressive knowledge on it, almost uncanny information they had that I didn't expect from a car dealer. Hyundai and Volkswagen were not charging premiums, but adding addendums, and you had to order the cars with various extra options. But they weren't overly excessive, to be honest. It was nothing like the Ford Mach-E. Audi was charging an additional $10,000 or so for an e-tron, but they were also adding an extra $10,000 premium onto any S-model Audis as well, which were fully gas-powered. The more basic models perhaps only a minor premium added. All of them were saying they had limited stock, and they were all blaming on the chip shortage. What cars they do have, they're generally marking up. But there is still stock. So hear me out. There is less supply available, but they still have stock. They're not sold out of stock. Despite having significantly less, if demand was higher, then surely they would have sold out more. I think there are two inferences here. Perhaps demand is high, that consumers have purchased a lot of the cars that were on the car dealer's lot, and now only a few remain, and the remaining few dealers are charging a premium where they can. Alternatively, supply has been cut because the auto companies have seen significantly less demand due to people transitioning to EVs, and this may actually be why they're suddenly taking EVs so seriously, as it's happening a lot faster than they all assumed, but still trying to relay the message out there that there will only be 50% by 2030, along with Biden's guidelines. Seriously, none of us for a second think there'll be 50% of consumers still wanting ICE cars in 2030, especially when EVs go below parity of the cost of ICE, which Tesla and the Chinese have already achieved. But Volkswagen still selling at retail prices is strange, or perhaps if I walked into the store it might be different and suddenly there is an extra $5,000 or so added on. But maybe Americans just don't like Volkswagens as much as Fords, which I find highly likely too. I think the Mach-E is superior to the ID4. I'm actually shocked at both the ID3 and 4, especially after the Volkswagen CEO, Herbert Diess, talked such a big game about EVs, and the fact Volkswagen is also a much bigger company than Ford or GM, and also the fact they got into the EV game fairly early with the Porsche Taycan. Customers can also order their cars at retail price, but for example, they said you'd have to wait 12 to 24 weeks for a Ford Mach-E. Production of ICE cars may be down due to demand, and demand is down because everyone bought a car last year, and everyone wants EVs now. Therefore, the legacy autos have possibly cut back their manufacturing due to demand. They need to conserve costs, as they are in a state of survival now. Every car dealer I spoke to said that they were seeing a massive trend to electric cars, and none of them tried to dissuade me in my electric car purchase either. They had no problem selling me an electric car over ICE. In fact, they even recommended it, and were telling me it's the future and the way to go. The Audi salesperson I spoke to actually drove an e-tron himself, but I guess if they are adding an extra $10,000 commission, then that does make sense. But I thought this was interesting. Although the Hyundai salesperson did try to push me into the hydrogen Nexo, and the car dealers are happy to raise their prices $10,000 above retail, which is significantly less than Tesla's price raise of just $4,000 for the Model Y. Well, I think this is quite a big deal and worth keeping an eye on too. I mean, either way, this chip shortage is not going to be sorted overnight, and if Tesla are able to still keep going without as much effect on chip shortages as legacy autos, then it's only going to further increase their overall market share of the entire auto industry. GM is actually taking it to the next level again and shutting down most of its North American plants and just leaving open the ones making the more profitable vehicles. I think this is major news. I can't see them ever reopening either. And they've totally blown their EV business due to the Bolt recall. Therefore, GM currently takes pole position of the first of the incumbents to go bankrupt, at least in my opinion. If the incumbents actually halt production, then this might indeed free up chips for Tesla too. Everything just works as a tailwind for Tesla and a headwind for legacy. I'm genuinely interested as to all of your thoughts as to what is going on too, so please do leave them in the comments below for us to discuss. There are no cars more profitable than a Tesla. No car has more demand than a Tesla. Therefore, Tesla can outbid every other car company when it comes to any components. The same is true for batteries. And Tesla can easily enough raise their prices to cover any extra costs, and still remain below market clearing price where supply meets demand. In the meantime, if the legacy autos simply have less cars available, then they'll have less supply, and they raise prices. Then they lose even more demand, and consumers turn to Tesla, as Tesla has raised their prices relatively less. So legacy autos may actually become more expensive, even including their ICE vehicles, but especially their electric vehicles, which means demand for them will fall, which means demand for Tesla will increase as consumers are looking for electric. And Tesla is going to not just be better value for money, but actually cost less too, especially if the car dealerships are adding an extra $10,000 on every car. This is the trend. It may end up happening a lot faster than we all thought. Legacy autos are in a total vicious circle here, and various black swan events have acted as a catalyst and made it too hard for them to navigate as a business. Far too many diseconomies of scale against them. They can't react fast enough, unlike Tesla. Now, just imagine if on top of all this, the government then add a $12,500 tax credit. What do you think the car dealers will do then? Like I say, it's great having a front row seat and watching how all this pans out, even despite so many spoiler alerts. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.